Okay, so back on to budgets. This week is going to be just a hair more complicated, but I think if you've got last week, you're fine, and then of course this week, if you've got if you got this chance to review it, you should be okay. So onward. Okay, so here's what our partial budget looks like with our payables and receivables. So recall that if we sell it in January on credit, and we assume the example is all 100% credit, we get our money actually in March. So we got the 2 month lag there, even though our terms might be 30 days. We send an invoice out at the end of January. We typically don't get paid till March. So if we look at the payables now, we've got things that we purchase. And so in January, we purchase goodies that we're going to sell in February. So fairly simple there, and we assume we're good customers, so we're going to pay them in February. Now, when we add everything up in January, we have net cash in or out of zero because nothing really moved, although we quote unquote made sales and made purchases. No cash actually changed hands. February had some more cash payments. We paid for our January goodies that we bought in January. But still, when we have sales, if they're all on credit, we still got money in. So our net cash flow is minus 10. March looks a little better because our net cash flow is minus 5. April, we're even. May, we start to catch up and pull ahead. And June, of course, we're sailing. This is a typical business that does most of us work in the summer months, whatever we're selling, whatever the case may be. Now, the key to remember is that even though we don't actually have, in February, for instance, a huge amount of money out, we still, in terms of cash flow, have 10 going out compared to 0 even the month before. The danger sign, according to the danger area, is in the cumulative cash balance. So we go from 0 to minus 10. Well, that kind of makes sense. And then in March, we go to minus 15. We go to minus 15 because March and February are both net cash out months. So we have both of those months, even though we might have some minor inflows of money. Overall, our net is outward, and when we add that up, it adds up to minus 15. In April, we have cash in and out that's equal, approximately equal. But we still have that cumulative balance of minus 15. This is the parts that a lot of business owners don't catch. They say, well, gee, I'm only cash deficient in February, 10, and then in March, things are getting better. It's minus 5. April, we're actually even. Yes and no. It's great that things are starting to catch up, but we've still got that negative cash balance. And this is the killer. Okay, because remember, we can't pay the rent with an IOU. We can't pay our employees with an IOU. So those months that we're in the negative balance, we need to actually have cash kicking around or the ability to borrow it. And this is what the budget's all about, because we see things like this and we go, this is not good. How am I going to even feed myself, let alone have my employees feed their families? So this is what we have to really consider. And the cash budget, of course, does that. So let's continue. Okay, so doing the cash budget, we figure out the month transactions that are going to be journalized or entered into QuickBooks or Simply Accounting, whatever the case may be. We do this as they happen. Now, as far as Excel goes, we're estimating future purchases, so we do that in terms of putting them in the correct month. And let me see. We do our total purchases for the month, and we've already run through that calculation that we try and break it up into monthly bits based on historical cash flow. Okay, and also from historical, we'll know how much is going to be on cash and how much is on credit on our purchases. Okay. Then we put each into each appropriate month and go from there. Similar thing, of course, happens with our sales, our credit sales. We do the same things, figure out how much our monthly sales will be, and divide them up if there's any ups and downs and that sort of thing, and then figure out what the receivables will look like. So similar thing here, even though it doesn't really mention it, I thought I'd expand. Remember, this is review. Okay, so far kept it simple. Haven't assumed any cash sales or cash purchases, but we still have other things like salaries, rent, interest, buying new machinery, capital assets, that sort of thing, paying off loans, interest, dividends. This, of course, sounds a lot complicated, but it's not really that bad using Excel. Okay, I'm spending a bit of time reviewing these things because it needs to be kind of recalled frequently. We omit payroll taxes and HST since they're flow through. Remember, payroll taxes are the employee's share of CPP and that sort of thing. Not talking about what the employer matches. Okay, and HST is a flow through. So we pay HST and then we collect HST and we give the government the difference. Okay. Company portions of payroll taxes are accounted for by grossing up. So if somebody's costing us $10 an hour, we multiply that by 1.1 because we have to pay CPP portion and employee insurance or employment insurance and other odds and ends. So we gross that up and assume that we pay them instantly. It is a bit of a fudge in that we tend to pay our payroll taxes every 3 months. But if we're conservative and say, okay, we're going to take them and account for them right now, then it works for the cash budget. Okay. We do account for the company's income tax payments because they can be sizable, assuming the company makes profits, and they're typically paid every 3 months as well. Okay, so quick note on averages. 45 days means we'll probably see it 2 months from now, and on average, everything's collected 15 days before and 15 days after. Okay, and if we pay our bills, even if we pay our bills 2 weeks after we get them, typically it's counted as a 30-day payment cycle. Okay, as mentioned, we've only covered the AR and the AP side of things. Now we have to look at the actual operating activities, and they're the expenses typically. Okay, so we look at other variable expenses first. Variable or direct are the sort of things that go up or down as sales go up or down. Okay, so usually we'll see some fluctuation in labor and things like that in the manufacturing part of things. Again, we tend to look at these as a little bit separately than buying our goodies that we're going to build. But we do, if we're going to do a full production mapping, then we have to look at the fact that our labor may increase a month or two before we actually sell the goods. In the service business, usually labor goes up and down the same month as the sale, because for performing the work, then obviously we're going to be billing for it that month. We can't really bill in advance. In that case, it becomes a unearned revenue or something like that. So we tend to actually bill the same month that the that the labor expense is incurred. So not much of a lag there at all. Okay, now that's in the accounting side of things. If we're doing it physically, it tends to happen a wee bit of a lag, but we don't really account for it in the budget. We do it beforehand. It makes life a little bit simpler, and again, is a conservative way of doing things. That way, if our budget shows that we're in a negative situation, a minus situation, and we're being conservative, we can say, okay, in a really bad cash flow month or situation, we can say we've got a bit of a cushion and that we don't have to pay part of the labor till next month. But that's the sort of thing you don't really want to play with. You'd rather have the cash reserves up front or the credit line in place. So you really don't want to worry too much about it. Okay. And again, labor is not counted as accounts payable except in very, very special situations, and we won't address that here. Okay, so after variables, we look at our fixed expenses, rent, salaries, advertising, utilities. I mentioned utilities in the previous slide, but assuming there's no variation or up and down in utilities because of the sales, again, they go in the fixed expenses. and things like insurance as well. Then we look at the financing in the government. So if any new loans come in, or we repay some of our old loans, any interest we've had to pay, company shares bought or sold, again, that's financing, and dividends. Okay. Now, we also look at income tax payments. That's the government part of things. We don't look at HST, and the payroll taxes are covered by, let me think, grossing up our wages expense or in our salaries expense. There are some other government things we have to look at as well, like property taxes, but those are a fixed expense. They're kind of like rent, and we get a notice for those once every couple of months as well. Usually we pay those quarterly too. Then the final thing that goes in our budget is investing, whether or not we buy capital assets or sell them, whatever the case may be, new roof, new equipment, new building, new land and building, whatever the case may be. We do that at the bottom of the page, just before our cumulative calculations. Okay, so that concludes our lecture entirely for week 9 and onward towards the actual Excel calculations.